Hey, my name is Jan Dishev, and I'm here with Rob Arnold, and we're going to be talking to you about our idea for an integrated circuit board export business based out of Singapore. The value for our company will come from harnessing the relatively higher productivity and skilled labor force of Singapore to produce high quality circuit boards at an affordable price, then take advantage of Singapore's extensive market connections to export the boards to the US markets. The current circuit board market is dominated by Asia, with the top importers in 2018 being Hong Kong and China, who represent 46% of imports, followed by Singapore, 7.5%, and Chinese Taipei, 6.5%. The top exporters are South Korea and Taipei, whom represent a combined 35% of exports, followed by Singapore at 10% of exports, and Malaysia at 9%. We are choosing to operate in Singapore because it has one of the lowest international business level risks in the world. According to Investopedia, business risk is typically made up by three individual risks: foreign exchange risk, political risk, and protection for international businesses. Because according to the Monetary Authority of Singapore, they have a strong monetary policy that is periodically reviewed to stay consistent with international exchange rates and the fundamentals of the Singaporean economy. Political risk in Singapore is also very low. They are a democratic country that has democratically elected officials and haven't seen any recent political disruptions. According to the Credendo Group, Singapore's short-term political risk is 1, the lowest possible score out of 7. The final international risk is protection for international businesses, and Singapore turns out to be one of the safest in terms of patent protection. In 2019, the World Economic Forum's Global Competitiveness Report ranked Singapore as the best in Asia and second best in the world for IP protections. Low business risks aren't the only reason why we chose Singapore either. Singapore has historically been a forward-looking business and a business-friendly nation. New companies in Singapore receive an exemption of up to $125,000 out of their first $200,000 income in the first 3 consecutive years of business. Foreign firms that come have it even better, with 100% of their income for the first 3 years of their business made tax-free. Another great advantage of Singapore is their geographical location. They are located in the middle of the Southeast Asian region and have strong trade connections with the major economic powerhouses such as China, Hong Kong, and Malaysia. We would also gain access to Singapore's growing skilled workforce. According to the Total Workforce Index, which calculates the relative ease of sourcing, hiring, and retaining workers in different countries, Singapore is ranked best in the world. Although we will face higher labor costs in Singapore compared to other developing countries, the relatively high skilled labor force and high productivity will be a source of competitive advantage in our trade with US firms. In 2019, Singapore had the highest positive net exports of integrated circuit boards, which is calculated by subtracting net export value by import value. A positive net export value typically means that country has a strong competitive advantage in the industry, as they are exporting more value than they are importing, therefore creating value. Additionally, for the past 4 years, we have seen an average export growth rate of about 3.5% from Singapore, which is a good sign that the industry is still growing.
All right, so first we're going to look at the US-Singapore trade relationship. Here on the right side of the screen, you can see the pie chart that details which sectors make up the relationship. The two we're going to want to focus on here are electronics at 13% and re-imports at 14%. So this trade relationship was made possible by a free trade agreement negotiated from 2000 to 2003, which resulted in reduced duties on U.S. products coming into Singapore, as well as Singaporean products being exported to the U.S. They are a sizable trade partner, ranking 16th in the list of U.S. trade partners, and Singapore's exports to the United States are on the rise by a significant amount in recent years. Next, let's take a look at the worldwide chip market. So this is a very important industry for things like mobile phones, cars, basically any internet-connected device. And recently, there's been a slump in demand, mostly due to the uncertainty associated with the trade war in 2019. But despite this down year, 5% growth is expected in the industry. And this growth is going to be driven by things like the Internet of Things and 5G development, which is going to increase demand for chips across the globe. Some of the major producers include Samsung, Intel, and Taiwan Semiconductor, with countries like the United States, South Korea, and Taiwan being major hubs for chip production. Here we're going to look a little bit closer at some of the major competitors in the chip market. So as for foreign competition, previously mentioned Samsung and Taiwan Semiconductor are big, as well as SK Hynix. These are located in South Korea and Taiwan. In the US, domestic companies such as Intel, Micron, Texas Instruments, and Broadcom make up the majority of chip production. And as far as the Singaporean marketplace, UTAC, which focuses on testing and assembly of chips, and AMS, which is a large supplier to Apple, are some of the major chip companies. Here we're going to look at a comparable firm to the one we wish to set up. This is going to be UTAC in Singapore. One of their major production hubs is in Singapore, but it is a global producer and they're owned by private equity firm TPG. The Singaporean unit earns almost all its revenue from exports, 53% of which are to the United States. Obviously, just like all other chip producers, 2019 was a down year, which you can see the numbers represent here. They took a big hit to their EBITDA, but the gross margins held decently solid at 16% on 700 million sales. In previous years, those were more like 20% on 800 million sales. So a recovery is expected soon based on 5G and other drivers. And I think our company has the ability to take advantage of some of these same tailwinds in the upcoming chip cycle.
On this slide, we'll analyze the economic rationale behind why we chose Singapore as a location and computer chips as a product for our export business. If you look at the chart on the right side, you can see that Singapore ranks very high in the Human Capital Index, which means that they have a large percentage of skilled workers in their population. These are the type of skilled workers that are necessary for producing computer chips. Beyond that, it also has great geographical location and status as an international trade hub. So there's existing shipping lanes to the United States that we can take advantage of. It has a lack of trade restrictions and good trade relations with the US, so exporting our products will be relatively easy. Despite the recent slump in chip demand, there should be a rebound based on IoT and 5G growth in the next few quarters. So why did we choose the US as our export partner? Well, if you look at the chart on the right over here, you can see that semiconductor demand growth is the highest in North America compared to any other regions at almost 20%. So the future is bright for chip sales in the United States. This 2018 data should be more representative of the overall trend. Since 2019, the trade war kind of disrupted a lot of international economic activity, and currently in 2020, the coronavirus outbreak is still disrupting economic activity. So based on this 2018 data, there should be growth similar to that in the near future. The United States is also pioneering in areas like 5G, AI, and Internet of Things tech that are driving more chip sales. And overall, they've been very receptive to Singaporean exports throughout the years.
For our final economic rationale, we're going to consider a U.S. tariff on Chinese goods. Understanding the effects of a tariff on U.S. consumer prices and world prices can help us understand the benefits a tariff on completed Chinese integrated circuit boards could bring to our company. Although trade barriers are generally a bad thing, if the US starts importing less from China, our company can help fill that gap, which could strengthen our competitive advantage. So we're going to start off with the foreign market, China, which is represented by the graph farthest to the left. With free trade, the price is PW, and China is willing to export X1 amount of items, which is the difference between their domestic supply and demand at the world price. On the world market, represented by the graph farthest to the right, we can see the initial equilibrium trading point between the US and China at point B star, where US demand, M, equals foreign supply, X star. Once a tariff is added, the foreign supply line moves up by the amount of the tariff, driving US prices from PW to P star plus T. Consumers must now pay a higher price than before for products, and foreign producers will have to pay more to export. This decreases the quantity demanded in the US from M1 to M2. Although producers in the US would gain from tariffs due to increased prices, US consumers and foreign producers would foot the bill. We can see the decrease in US consumer surplus in the home market graph, which is represented by the letters A, B, C, and D. This loss is caused by increased prices as well as decreased consumption. US producer surplus gains are represented by area A, because before the tariff, they wouldn't have seen an increase in sales price and domestic quantity supplied, and therefore would not have been able to make more profit. On the world market, we can see the effect of a tariff on Chinese producers, represented by triangles E and F. As we can see, both countries are hurt from tariffs, but that has not historically stopped the US from imposing them during trade wars. Currently, there are only tariffs on various inputs of ICBs, which doesn't have a large effect on the world price of the completed ICB because the tariffed input does not make up a large portion of the final good. But the US is considering imposing a 30% tariff on all completed ICB imports from China, which could raise world prices substantially. Chinese producers would then become less competitive in the ICB industry, and our company could take advantage of their higher global prices. So moving on to potential risks, we have come up with 3 potential hazards our company could face doing business in the Singaporean ICB industry. The first risk is the potential for an anti-dumping case from the US. Although the risk of this happening to such a large and diverse industry is relatively small, we must still consider the effects it could have on our long-term business. Singapore has generally been pretty safe when it comes to US trade restrictions, but in 2019, Singapore caught an anti-dumping case when they were found to be dumping acetone on US markets below world prices. One major problem we can foresee is an increase in world prices of ICBs as a result of a US tariff imposition on Chinese completed ICB chips. If our company continues to export our chips at the pre-tariff world price after the tariff has been put on these Chinese completed ICB chips, the US could charge us with dumping, even though we're not really dumping, we're just charging what we used to charge, and we could face an anti-dumping duty which could hinder our business. We must be sure to reflect domestic ICB chip prices in Singapore on our international prices, so the US does not accuse us of selling them to them for a lower price than Singaporean firms charge domestically. The second, and probably most dangerous risk we will encounter, is an increase in competition from neighboring Southeast Asian countries, specifically Taiwan and South Korea. In the past year alone, their export surplus has grown by 26% and 110% respectively, which points to an increase in competitive advantage for these two countries. Additionally, Singapore saw a 28% decrease in export surplus, which could mean Singapore has a diminishing comparative advantage in the ICB industry, and they could soon lose their competitive advantage altogether. The last risk we have to consider is changes in manufacturing productivity and technology. The ICB industry has been rapidly developing in the past decade, and still has the potential to change significantly. One example of a technological change that could drastically affect our profitability is the release of ICB 3D printers, which are capable of printing a circuit board. Although they are not yet advanced to make traditional ICBs completely obsolete, they do pose a risk of shortening the average manufacturing time and minimizing the amount of suppliers that are needed to produce the chips. If our business model of providing ICBs to the US is made obsolete by advanced technology, we could lose our entire business. Nevertheless, we do believe Singapore offers the best hub to do business, and the many advantages Singapore brings to the table outweigh the potential risks involved. Thank you.